My name is Cherry Solomon. Obviously, hopefully a lot of you all know us by now. I'd like to thank you for joining us on this tax policy update and tax credit opportunities webinar. Thanks for joining us today. As you know, K&S got acquired late last year. It's been a really busy 6 months, mostly getting to learn all the resources that Cherry Bekaert has, our new firm. We've expanded our resources in order to serve you better, and many of our clients are starting to see this firsthand. And with that, we've decided to launch a series of short webinars to educate our clients regarding tax credits, incentives, cybersecurity, tax planning, and many, many other events to come. Today's webinar specifically focuses on the latest in new tax policy, as well as various tax credits and incentives, such as R&D credits, and how you can qualify to take advantage of this. Because our office here in Boston works mostly with tech and life science companies, including many of you which are on the call today, you've probably already dealt with the R&D issues and are trying to wrestle with that every day. Some of these changes have impacted all of you negatively in some respect. So what we want to do is give you a chance to hear from our experts and learn ways of what's going on down in Washington right now, because there's a lot going on down in Washington, and give you ideas on how to present your company in the most favorable light and be intentional on your planning going forward in 2025. Like I said, this is the first in a series of seminars we're going to be offering, so hopefully you're going to join us for many others and look for invitations coming along for next month and in July as well. Before I turn it over to our speakers, a quick housekeeping note. We welcome you to encourage questions from all of you, okay? So please use the raise hand feature, and our moderator will allow you to come off mute and ask questions as we go. Or if you prefer, you may post it to the Q&A box. Again, I want to thank you for being here today, and I'm pleased to turn this now over to our speakers, Marty, Vivian, and Casey, and I'll let them introduce each of themselves as we move forward with the presentation. Marty?
I'll go ahead.
No, my apologies. I was having trouble coming off mute there as I was sharing the thing. Yeah, happy. I'm going to go later in this. My name is Marty Cameron. I'm in charge of our tax credits and incentives group. You're going to first hear from Casey Pittman, and then also Vivian Kors. You want to introduce yourself?
Yep. I'm a partner in the R&D group focusing on R&D credits and Section 174. And I've worked very closely with Marty and Casey on the latest and greatest in tax policy.
Casey.
All right, I'm Casey Pittman. I am the Director of Tax Policy, and I'm going to kick us off. So, Marty, if you want to advance some slides. This is our just general agenda. We're going to talk about tax policy, and then we'll get into tax credits and incentives and Section 41. So we'll move to tax policy overview. I'm going to keep this brief and high level. There's a lot going on today. By the way, Jeff, amazing day. Maybe the most interesting day in Washington in a couple years. So I'll have some to say about that a little bit later in my presentation, but good job scheduling. Why are we here? Tax policy. Tax policy affects decision-making. It affects the economics of how we structure deals, how we do business, what we invest in, and it can move economies. And so we are at this precipice right now because there are a number of TCJA provisions that have expired or are about to expire. We've seen most impactful for businesses, 174 changes, 163J changes, bonus depreciation changes that have already been enacted. And then we've got a whole host of items that are expiring at the end of this year, but for, Congress passing a new tax law. So here we are. Republicans, really quickly over the governing dynamics, Republicans have a majority. They swept the election. They have slim majorities, though, and this is important to note. In the House, actually, this slide was made a couple days ago. In the House, right after the election, it was 220 Republicans, 215 Democrats. We've actually had a third Democratic representative pass away. And so right now the margin is 220 to 212. That actually was announced this morning. So does that change the 3-vote margin in the House? It does not, because if you were to lose 4 votes, if everybody votes and you lose 4 votes, 220 to 212, that's a 216 draw. And in the House, there's no tiebreaker, and anything that ties fails. So just to set the stage here, we're working with a really slim margin. Just a little piece of information for you. In 2017, when the Tax Cuts and Jobs Act passed, 13 Republicans in the House voted against it, primarily based on state and local tax concerns. In the Senate, we have a 3-vote margin. If you lose 3 votes, that's fine. You're tied 50-50. You've got the tiebreaker of the Vice President Vance. He will come in and vote with Republicans and the president. So you can lose 3 votes in each chamber. The 4th vote, you fail, because Democrats will not be supporting this process at all. A little bit more stage setting. The annual deficit, Marty, could you advance the slide, please? This is our annual deficit from last year, FY24. That's the year that ended on September 30th of 2024. Our deficit was $1.83 trillion, and this is substantial. Just so you know, this is over 6% of the United States GDP. Our historical average over the last 50 years is 3.8%. 3% is a comfortable margin in terms of running a deficit for a nation that is as advanced as we are and has the ability to spend more than we bring in. So here we go. We had $4.9 trillion in revenue and $6.7 trillion in spending. So we ran a $1.8 trillion deficit. When we run a deficit, what we do is Treasury issues debt, and some of it is purchased by Americans, and some of it is purchased by foreign governments, and some of it's purchased by institutional investors. But to fund the government last year, we had to issue $1.8 trillion in debt. And I will tell you the reason that this is so important is because of that 1.8 trillion, of the 6.7 trillion we spent, over 1.1 trillion of it was the interest to service the debt that we have outstanding right now. We have $36 trillion of debt outstanding. So we are not on a great course. Our deficits have increased substantially over the last decade from both Republican laws and Democratic laws. There's no one quick thing to point and say, hey, this is the cause of this issue. We're just at a point where we're spending more than we bring in a sort of unsustainable level. So this is sort of backdrop for where we are in terms of negotiations. CBO has estimated that we'll have a $1.9 trillion deficit this year. CBO is Congressional Budget Office. We were actually at the halfway mark already at 1.3 trillion, so it may exceed that. Go ahead, next slide. These are our national debt levels, which is a little bit of what I was speaking about here. The national debt, again, is the sum of all the debt we've had to issue over the years to fund those deficits. Our current debt level is $36.2 trillion. Also coloring discussions right now is the fact that we are no longer able to borrow any more money. In 2023, there was a bipartisan compromise, and we suspended our debt limit, saying, we'll borrow whatever we need to get through this period up until January 1st, 2025. They pushed it past the election. It wasn't going to hurt either party in the election. On January 2nd at midnight, we instituted our debt limit again. So as of that date, we have not been able to borrow any funds. So what are we doing right now? We are paying our bills using what's called extraordinary measures. And it's just a whole bunch of moving funds around in the way we do things with the money we control inside the federal government. Treasury does this. Treasury issues an estimate on what is called the X date. And the X date is the date where we will no longer be able to move money around such that we'll be able to pay all of our bills. We would default on our debt. And that is a terrible consequence. We came pretty close to it in 2011, I think within a week or two. And that's when we saw our first debt downgrade, our bond rating downgrade. That was S&P in 2011 downgraded our bond rating. We lost our last perfect bond rating on Friday of last week, amid ongoing concerns about debt level and an inability to rein in spending. So the X date last official estimate was somewhere between August and September. The Treasury Secretary did issue a letter a couple days ago saying, hey, it's pretty hard to determine what the X date is. You know, as we get closer, it's easier. We're still counting money coming in from our April 15th tax revenues, and we think it will be sometime in August, and it asked Congress to go ahead and raise that debt limit before they leave for their August recess. So that's pretty soon, right? You know, we've got 2 months to get this done. And what Republicans have decided to do was to include it in their tax and spending bill. Okay, next page, please. We are going to talk just a little bit about the reconciliation process. Why are we using reconciliation? Reconciliation is a special process that was came about in the 70s, and ultimately we use it because you can overcome the filibuster in the Senate. In the Senate, you only need 51 votes to pass a bill, but in most instances, you need 60 votes to end debate. Debate can go on endlessly. It's called filibuster, unless you've got 60 votes to essentially say, hey, we're done with this, we're ready to go. So they don't have a 60 vote majority in the Senate, so they need Democrats, but not for reconciliation. And reconciliation, so it's an expedited process, but it comes with a number of, I would say, limitations, particularly in the Senate. And they are about every single provision in there has to be primarily focused on the budget, not, you know, merely incidental to the budget. You can only increase the debt inside the budget window. Budget window is typically 10 years, and it is in this case again, by the amount specified in the reconciliation instructions. And you cannot increase the deficit outside of the budget window at all. You can, like, one provision can increase the deficit while another one decreases the deficit, as long as outside of the budget window, we're not spending more money than we're bringing in, you know, because of this new legislation. And there are a number of other issues, can't affect Social Security, things like that. So we've been doing most of our tax legislating via reconciliation. And I think we're very focused right now, and I am in this moment very focused on this 2025 bill and what happens. And again, we're almost about to talk about what's in it and what we're dealing with. But just laying the background, I'm also concerned about 2026 midterms, 2028 election, and what is likely to be a 2029 tax bill. Tax policy has become inherently impermanent because of the way we are passing tax laws. Reconciliation was not meant to be a partisan tool, but that is what it has become over the last 2 decades. These are the tax legislations that were passed via reconciliation. You'll see that we have not had a single vote from the minority party since the last Bush reconciliation bill in 2005. We had the Healthcare and Education Reconciliation Act, that is Obamacare, in 2010, not a single Republican voted for it. Tax Cuts and Jobs Act, not a single Democrat voted for it. American Rescue Plan, not a single Republican. You see where we're going back and forth. So this is how we're passing tax law, and it leads to an inherently uncertain tax policy landscape. You know, we'll say, if we presume that Republicans are successful in getting this bill across and they make some provisions permanent, they talk about them being permanent, it doesn't mean they're going to exist forever. It just means they're not set to expire. And we have expiring provisions because, right, we're turning all those dials and trying to fit into that budget number that we're allowed to spend inside the reconciliation window. That's how it works. So that's why we're watching not only this bill, but also what is the minority party and what are the disenfranchised members of the majority party, the Republicans, what are their goals that didn't make it into the bill? We need to keep our eyes on those and plan for and mitigate for, you know, eventual, I would say, resurfacing of many of these ideas. Next slide, please, Marty. This is the reconciliation process. And I will show you, right? So we get a budget resolution. We have a budget resolution. We have a really interesting budget resolution this time with really different instructions. First time ever. It's a novel approach. Different instructions for the House and the Senate. Talk a little bit about that in a second. Each chamber gets their instructions. They all write their bills. They pass out of each chamber. We've already done that in the House. Every chamber passed it. It goes to the House Budget Committee for assembly. They passed that. They actually had a little bit of a issue passing it on Friday, and they passed it on Sunday with 4 Republicans who originally tanked it on Friday, and now are let it pass on Sunday by voting present, didn't vote for it. And then it all gets packaged. It's at the Rules Committee in the House right now. And the Rules Committee is where you can make changes. That's what we're sort of debating on right now. It's a very active day. That'll go through the House. And if it comes out of the House, then the Senate will move next. They'll take that product and they'll either alter it, or they will go ahead and say, that's cool, you guys produce that. We're going to produce our own thing. And at some point, they have to be reconciled. The two chambers bills need to be reconciled. Once that's done, each chamber has to pass an identical version, goes to the president for signature. But we are in the committee, we're past the Budget Committee Assembly Act, but we are not onto the House floor yet in the House, and we have not yet begun. We've only done the budget resolution in the Senate. Okay. Crafting the tax bill. This is where we are. We are looking at so this is our budget resolution framework. It's very, very different between the chambers. The House is a pretty diverse conference. You've got some members who are moderate Republicans, and several of them are from blue states, right? We've got New York, California representatives. And so we've got that, and then we've got some really hardline conservatives in the conference. And again, you can only lose 3 votes. So we're in the middle of sort of a little tug of war between the two, and I'll get to that detail in a second. But this was a hard fought compromise that the budget House produced, right? They said you can cut taxes by a net $4.5 trillion if you get $2 trillion in spending cuts. If you only get $1.5 trillion in spending cuts, you can only cut it $4 trillion, right? And everything moves sort of in that scale. You get more, you can cut more in tax. You get less, you can cut less in tax. So where we are right now is that they are cutting about $4 trillion in tax net, and they are cutting they're spending $4 trillion in tax in terms of like, hey, we're going to reduce tax revenues by $4 trillion over this decade. And they have cut $1.5 trillion of other expenses. The biggest program of that is Medicaid, and SNAP benefits. And that's where we're seeing some issues here. In addition, they said, hey, you can raise the debt limit by $4 trillion. We know we've got an issue. The Senate has a little bit more strict rules. So they said, look, we are not going to promise that we're going to cut $2 trillion. We're going to aspire to cut $2 trillion, either in this bill or some combination of bills, but we are only requiring our committees to cut $4 billion, billion with a B, right? And we're doing trillion with a T over in the House. So we have very different instructions. The Senate does not care as much about paying for this bill or reducing deficits as the House does, as some members in the House do. Additionally, they said, we're going to actually use this current policy baseline. We're going to assume it's never been used before in reconciliation. We're going to assume that extending current policy costs $0, right? We don't have to, we're pretending that the expirations don't take effect. We're going to use this current policy baseline. And in addition to that, we'll cut another net $1.5 trillion in taxes over the next 10 years. So we haven't seen the Senate plan, right? All we've seen is some commentary from some of the policymakers on what they're into, that they like or what they do not like in the House plan. So this is a novel approach. All through this process, what we've done, what the Republicans have done here is they've punted hard decisions, and some of that is coming to roost right now. Some of it may come to roost later. So House went first. Where are we right now? We got this budget through, we got this tax bill through the Ways and Means Committee, and I'll talk about what's in it in a minute. We got it through the Ways and Means Committee, and we got it to the House Budget Committee. It passed there. Now, we have sort of these last minute issues with SALT Republicans. We've got Mike Lawler, Nick LaLota, Young Kim in California. There's 5 of them, sometimes joined by Elise Stefanik, sometimes 6, who are saying, look, we are the majority makers. You don't have a majority without us. Chip Roy, House Freedom Caucus, you were going to get those seats no matter what Republican you put up in there. We are the majority makers. We're the reason you have a majority, and we need to deliver for our constituents, and we need to increase the SALT cap. And so we've been back and forth for weeks, and there is actually a deal that came out this morning. House Freedom Caucus members who are really, really concerned about decreasing the federal budget are saying, hey, we're not cutting enough Medicare. We're not cutting these IRA credits soon enough in the proposed bill. All of these are sort of deferred. We know what happens with when we say, oh, we're going to cut it later. It never comes to fruition. We really need to get on a better course from deficit spending. And it's sort of this balloon. You push on it this end and there comes out that end, push on it this end. It's a fine needle to thread. And so we wound up at the Rules Committee. They started their markup at 1 a.m. They still have not seen the manager's amendment. That's the sort of vehicle where they'd say, hey, here's the SALT change, here's the Medicaid change, here's the IRA change we want to make to the bill. We haven't seen that. And 90 minutes ago or less, House Freedom Caucus came out. They did a press conference and they said, we're not voting on this bill. We are going to vote it down. There's work to do. We need to cut more spending. It doesn't meet the moment. President Trump said, you need to come to the White House. So they're coming to the White House at 3 p.m. So we're literally in the middle of an active negotiation. Capitol Hill is going wild today. It may be the most interesting day, again, that we've had in years. So let's talk about what's in the House bill. So next slide, please, Marty. So big themes here. Again, really encourage questions. Please ask them if you have any. Our main themes for businesses is 174 extension, 163J extension, bonus extension. Those are all temporary. They expire at the end of 2029. We have increased, and for those, 174 is domestic only expenditures, 2025 to 2029. The foreign is still capitalized over 15 years. 163J is the switch from EBIT to EBITDA in terms of calculating that ATI number. Bonus depreciation is 100%. We've introduced this qualified production property concept, and that is to incentivize the building of new factories. That kind of works hand in hand with the tariff trade policy that we're seeing the executive branch execute. Increase in Section 179, change to opportunity zones, sort of shortening the current opportunity zone window, shifting the incentives a little bit and creating a new window that runs, I believe, through 2033. We've seen extensions of low-income housing tax credit, and then we've also seen some revenue raisers. Not significant here. Sports franchises, the 1% floor on charitable contributions. If you don't give at least 1%, then your charitable contribution isn't deductible on your corporate tax return. In fact, it's only deductible if you go over 10%. So let's say you give 10%, you'll only be able to deduct the 9% between 1 and 10%. If you go over, that 1% isn't deductible, but it turns into a carryover for next year. Ending the ERC, employee retention credit, early, actually retroactively to like 15 months ago to the end of January 2024. We're seeing some pass-through entity items. We saw an interesting expansion of 199A that wasn't on anybody's bingo card from 20% to 23%. Was a surprise. But we also were seeing this issue with pass-through entity taxation. And it's mainly, again, if we're talking mostly life sciences here, it's unlikely to affect many of you, but for those specified service trades or businesses, the accountants, the lawyers, the consultants, it would essentially not allow them to claim entity level taxes anymore on their flow-through entities. It would push them off to Schedule A, which is going to have this SALT cap limit I'll talk about in a second. It would also take these excess business loss provision. I'm not sure how many people have been involved in had that affect their returns, but it limits the flow-through losses you can take, the amount you can take and offset ordinary income. Right now, it just turns into an NOL. You can get it all the next year. This would subject it to retesting, making it really a true limit. International, we're seeing current GILTI, FDII, and BEAT rates continue. They're all scheduled to change at the end of 2025, absent intervention, and we're going to keep those preferential rates under this bill. And then we see the introduction of retaliatory measures to the extent we believe that a country is implementing retaliatory tariffs, which the DST, the Digital Services Tax, is certainly considered one of them, in addition to UTPR. That we would be able to, the Congress or Treasury Secretary would say, they're implementing this regime and they're increasing tax on those businesses and those foreign owners paying U.S. tax by 5% per year until it's a 20% increase. So that's certainly significant. For individuals, we see broad extension of the Tax Cuts and Jobs Act made permanent. The bill has a $30,000 SALT cap in it with a $400,000 income limitation. Then it starts to phase out. And this is what the SALT caucus did not like. They wanted much, much more, but it seems as though this morning they have settled on, we don't have the details yet, but settled on $40,000, still having that marriage penalty. So whether you're single or married, $40,000, a $500,000 limit for 10 years, and then a more gradual phase out when you're over $500,000 than we see for typical phase outs. But again, no details yet for us. Minor expansions of the child tax credit and standard deduction, again, only for the time that Trump is in office. Tax-free overtime, tax-free tips. You can't change Social Security with a reconciliation bill. So instead of that, we see a $4,000 deduction for seniors. The deductibility of car loan interest for cars that were assembled in the United States. A little bit of that charitable contribution thing we had in 2022, 2020, or 2021, 2020, where you could take it above the line. You didn't have to itemize, minimal there. In trust and estates, we see an increase in the lifetime exemption from, right now it's at base of 10 million, kind of tied back, index for inflation. It would be in 2025, it would be 13.9 million. This would change it to 15 million. The base would be 2025. It doesn't go into effect until 2026, but it would be about $1 million increase and indexed for inflation. We see changes to the endowment tax that universities have to pay, the private foundation excise tax increases there. And then I won't get too much into the IRA credits because I know that Marty and Vivian are going to be much more knowledgeable on the very specifics there, but we see some immediately ending. We see some phase outs and some limitations of the credits. This is something that is part of the House Freedom Caucus negotiations. They really believe that these should end immediately. And some of what we have heard has been negotiated was that essentially they would cut it off. They would accelerate the phase out over and above what was in the bill and cut it off early, such that almost no new projects would qualify. But again, we don't have the details on that negotiation. And those House Freedom Caucus negotiations fell apart, both Medicaid items, which we care about, but we don't focus on, right? Because we're focused on tax, and these IRA credits.
Hey, Casey,
yeah.
did you, maybe I missed it. Did you mention the PTE credit, the PTE flow through?
Yeah, for SSTBs. Mm-hmm.
Okay. Do you want to highlight that a little bit more for our people on the call?
Yeah. So right now, we have these changes in Tax Cuts and Jobs Act, and what happened is that people who are paying a good bit of tax for flow-through entities said, what the heck? If I have a corporation, I can deduct these taxes. I still have the same type of business. I've just chosen not to incorporate. I want to deduct via an entity level tax. I want my partnership to pay this tax to Connecticut. I believe was the first one. And I'd like to then claim a credit, a deduction on my return. It's kind of the same thing. And while the IRS didn't bless it, essentially, they said they issued a notice in 2020 that said, we're not going to come after you. We'll issue regulations. They never issued regulations, by the way, on this later. And what we've seen is that in this bill, well, in the SALT cap language, it wasn't even related to an entity. In the SALT cap language, it said, if you have, there's a lot of legalese here, but essentially, if you have a qualifying business, meaning 75% or more of your gross receipts are from non-SSTB income, you can still do that. Take that pass-through entity. That is an accepted tax. Everything else, there's a couple other, again, there's some nuances here. We could talk for like an hour and a half just on this. But everything else, you can't deduct. Partnership needs to separately state it. Partnership S Corp separately states it. The taxpayer can pick it up on their tax return, but right, it's going to be subject to that cap. So, good luck. For many SSTBs, the ones that really make a good bit of money, that would put them in a worse position than pre-TCJA. So will that be in the Senate language? I don't know. There is a lot of advocacy for removing that provision. I just don't know, right? There's not that much oxygen in the room. We've got Salt Caucus in the House, at least. We've got Salt Caucus and Freedom Caucus fighting about things right now. And so I don't know that it's on anybody's radar, but there is a chance the Senate may change it. And again, this is not a final product. None of this is a final product. So there is still time, but I do think that there's a lot of advocacy about that. I just don't know, sometimes things wind up in bills because the train is moving. They know that they don't like it. They know there's unintended consequences, and the train is moving too fast to make anything happen. And we saw that in TCJA. They knew that there was a drafting error with QUIP, qualified investment property, and they didn't change it. It took almost 3 years to change it. And so that is where we are right now with that PTET, or PTIT as we call it, issue. A couple other things. They did do a $4 trillion increase to the debt in this. They did make changes to 1099-K. There's something that wasn't in the Ways and Means bill, which is the tax title, but it was in the judiciary title that we're tracking. And it is changes to Public Law 86-272, which really dictates nexus and what constitutes a presence in a state. And so that really could be a game changer if that stays in the bill. So that's something our SALT team is really digging into. And there are a couple items that just were talked about widely, but were not included in the bill. So I like to point those out as well. There was no sea salt, corporate salt cap. There had been some discussion of that. There was no repeal of carried interest, although word on the street is that Trump is quietly pushing for that to be included in the Senate bill. There was no increase to the top individual tax rate, although that's an idea that pops up and dies almost daily at the moment. There's no increase to the stock buyback tax. There was no 15% corporate rate for domestic manufacturers, and there was no repeal of the estate tax. We saw a lot of buzz around all those items that did not wind up in the bill. So that is sort of where we are. I'm just probably going to pause for a second and say, we don't know, Marty, you can do the next slide. We don't know where this is going to wind up. We have some artificial deadlines that have been implemented by House leadership, White House. Senate hasn't really done that. And House leadership really wants to pass this bill by Memorial Day. I mean, that's Monday, and people are leaving town starting tomorrow. So they're having an issue, which is why we're having this big push by Trump and House leadership with the House Freedom Caucus, who's been summoned to the White House. We're going to find out here in like 90, well, the meeting starts in 90 minutes. So we'll see what happens with that. Here are our real deadlines. The biggest deadline is that all of this expires, all of the items, from TCJA that are expiring that have not yet changed, those business provisions that, have already changed, they all end December 31st. And that hits individual taxpayers, and those are voters. So that's really impactful for them. We back it up. September 30th is the end of the fiscal year. We have that budget resolution I said, which gives everybody the instructions, that expires after September 30th. If they don't pass a bill by September 30th, then they have to do a new, not that they can't do it again easily if they already have an agreement, but it's still another process you have to go through. September 2nd, that's the day that everybody's recessed. July 24th that's the day they come back. July 24th is the last day that both chambers are in session before the August recess. August being the time, at least right now, that we could run into our debt limit. So that is a deadline. If they can't pass the bill by then, they're going to have to find some other vehicle for the debt limit. The House leaves on the 24th. The Senate stays another week. The House could easily just stay another week. But we're going to see what happens. So we're under a lot of pressure. Things are changing. We are reading the bill. We have put out a piece, right, on, we put out a quick piece with, hey, here are the highlights. And then we put out a more detailed piece later last week that provides some insights into what's in the bill. Please read it. Contact us if you have any questions at all about, or contact your advisor about, how this might apply to you. But understand, this is not a final product. This is not a done deal. It's not tax law yet, but we do need to think about it because it may come late in the year and we may want to execute on some ideas. Either to, right, there's going to be winning provisions to make sure you take advantage of those to the best of your ability, or there'll be losing provisions potentially for some taxpayers, and we want to mitigate the impact of those to the best of our ability as well. So I think Maggie put that link in there for everybody. With that, this is the end of my prepared remarks. So I am happy to answer any questions if there are any, but also just pass it on to Marty and Vivian for their sections.
Yeah, if anybody has any questions on anything we've heard before, because we're going to talk a little bit in the tax credit side, about some of these provisions and how they're affecting specific credits. If anything you want to ask from the last session as well, just feel free to ask. So anyway, as I said earlier, my name is Marty Kehrman. Thank you for the time today. We'll talk a bit about our tax credits and processes, a little bit on our group so that you understand who we are. Within Cherry Bekaert, we have 40 plus, depending on how many incentives there are out there, people in the group made up of engineers, attorneys, CPAs, EAs, et cetera, all focused on credits and incentives. And where we're focused as a group are, to the extent you're a company who's investing in R&D, if you're purchasing or refurbing any commercial real estate, if you're investing in alternative energy, or if you have in the past, or if you're looking for a new site, or you're hiring, or really you just want to like lower your tax liability through potentially the purchase of credits, we are here for you. So we're really focused on what your desires are and what your activities are and trying to match a credit or incentive that goes along with that. In addition to those that are statutory, we also are focused on our state and local credit side of those that may be negotiated as well, specifically when you're looking for a particular location where you may be moving. So here's our group in terms of what our offerings are. There are probably myriad incentives like beyond this, but here's sort of like where we're focused as a group. And Vivian, after I get through this slide, is going to talk a bit about where we are from an overall R&D perspective and a process perspective with our clients, and potentially like some of the enhanced services that we can now offer from both a preparation and documentation perspective, but really just a planning perspective as well, in terms of like maximizing your credits and understanding exactly how much maybe you should be capitalizing and how to minimize maybe some of that as well, based on some methodologies that we have. So we're going to talk about 174. Vivian will talk about that a bit, as something Casey alluded to. Within the House bill, there is a provision to temporarily suspend the requirement for capitalization of domestic R&D, but does not do that to foreign. So since 2022, and really this was a product of TCJA back in 2017, it kicked in 22, that taxpayers began to have to capitalize and amortize their expenditures specific to R&D. It's created a lot of analysis, I'll just put it that way, some headaches for people as well, because despite the fact that it was there for 5 years, I think some providers didn't maybe let people know that this thing was going to hit them, because there was a thought that it would get kicked down the road or potentially like pulled out of the law. It didn't happen. So in 22, companies began to have to capitalize and amortize R&D. We're going to talk about that. We're also going to talk about why I think it's so important to look at our R&D now and prepare, because beginning in 25, there's going to be new documentation requirements just to even file. Because back in 2022 as well, I suppose, they changed the rules with respect to amended returns, that a sort of almost like a disclosure form had to be provided in order for the IRS to even look at it. Now, something very similar is being included on the form itself, on the form 6765. So if you've ever had like an R&D study, you may know that you'll put the numbers on the form, and potentially if the IRS were to look at what the credit claim was, then we have this documentation ready. Not anymore. We're really putting that on and making it part of the overall filing, as some other countries do. So I'll leave that at that, but that's kind of where we're focused on R&D, and Vivian's going to go into that quite in depth. Just so you know as well, to the extent like you have any holdings in like real estate, we also do cost segregation analyses as well to accelerate the depreciation on a building. In addition to that, there's beyond just basic cost seg, there is the Section 179D energy efficient commercial building deduction, where we will focus on the square footage of the building and what the overall energy efficiency of certain enhancements to HVAC and interior lighting and the overall building envelope may be as compared to an energy standard that's set within the law. That can be actually quite beneficial, and up to the amount you spend on it, but below that, up to a little north of $5 per square foot. And so that's something where we're focused as well. One thing that has caused I would say, return on investment a little bit in investing in a cost segregation study, if you place the building into service in maybe 24 and 25, is like bonus depreciation was something that actually certainly enhanced the benefit of doing a cost segregation study. Within this bill, this proposed bill, there is the proposal to bring back bonus depreciation, but only for buildings that begin construction after Trump took office. And so if you put it into it's not retroactive or anything like that. It's really focused on new construction beginning after he took office. And so it wasn't the bonus I had hoped for on behalf of our clients, because I had hoped that it would be a placed in service standard as opposed to a begun construction standard. Nevertheless, going forward, to the extent something like this passes, there will be bonus depreciation for 4 to 5 years again, going forward. Something Casey alluded to as well. Back in 2022, the Inflation Reduction, it seems like everything was 22. Anyway, the Inflation Reduction Act passed, and it was sort of a game changer in the alternative energy space, due to the fact that prior to that time, in order to take advantage of certain incentives, developers generally, like many times in the alternative energy space, didn't have tax liability. So they would enter into tax equity transactions with other investors to spin the attributes of the credits out to those that could use them. They were fairly complex and generally engaged in by like large institutional investors. Beginning in 23, when IRA took place, not only were many of the credits enhanced and expanded, but many of the credits became transferable. So if you didn't have a tax liability, you as a developer or as a company that just made investments into some alternative energy assets could sell those credits on the open market one time. And this has created an entire transferability market out there, which is why you're seeing, I think, a lot of pushback on just like eliminating everything with respect to IRA, because certain C corporations have the ability to buy credits that are put on the market by developers. And that's really the method that's become most common to monetize these credits and fund the alternative energy investment out there. What I will say is what we see in the bill that may or may not be brought to the floor is that some of the credits are scheduled to be eliminated, and some of them not surprising. Anything to do with vehicles, you've seen a lot of pushback on EVs. So the Clean Electricity Production Credit, which is known as 45Y, Clean Electricity. No, sorry, I'm doing this wrong. It's the 45W Commercial Clean Vehicle Credit, and the EV charging station credits as well are scheduled to disappear after this year, to the extent something like that passed. And the individual side, credits with respect to new and used EV vehicles would go away. And then on the sort of like basic solar and wind investment tax credit, production tax credit type credits, you see them phasing down sooner than they would have. The biggest thing that I've been focused on is whether or not you'll still be able to transfer these credits, because that would be a very, I don't know, sly way to kill the IRA without killing the IRA, would be to take away the ability to transfer some of these credits. It looks like the way it was at least drafted in what I saw a week ago. Now, this is also, again, we don't know what's going to happen, subject to change, is that transferability would continue at least through 2027. And so that's a good thing. Anything can happen after that, and you could see extensions in other pieces of legislation after that as well. But no immediate kill to transferability in 2025, 26, or 27, which I think keeps those markets for transferring credits alive. And so, again, we're focused on R&D, capitalization, credits. We're focused on cost seg and 179D to the extent you own real estate. We are focused on the Inflation Reduction Act to the extent you have investments in alternative energy, or you just want to buy credits that are out there. As well, if you're a nonprofit or affiliated with one, direct payment of the credit amount from the government is something that happened in the Inflation Reduction Act as well. So if you're affiliated with any nonprofits that may be making investments, that was something that changed quite a bit in the Inflation Reduction Act. Last couple things is from a state and local perspective, there's just a huge push right now with all the tariffs to onshore. I am seeing within our group a lot more discussion of site selection services that we may provide for companies, both foreign and domestic, that are looking to find a new site within the U.S., but especially for foreign, if you're looking to set up shop in the U.S. to avoid some of the tariffs, that would be something that we can help with. We are also pretty adept, not exactly in our tax credits incentives advisory group, but sort of an adjacent group, our strategic financing services. we're very focused on new markets tax credits. So to the extent you are adding jobs in any particular like pre-designated low income community, there is the potential to fund that development with a loan that essentially you don't have to pay back. Essentially, you pay interest on it for 7 years and get into a new markets tax credit transaction. A little too complex for this particular discussion, but finally, we are also focused on IRS defense. So not only are in the R&D world do we see the need to defend our work and show it, basically get in front of the IRS and have that discussion to the extent they have a question. We did a lot of work in the employee retention credit world as well, and that's quite contentious. We have seen the service, not necessarily for our clients, but for others, deny a number of credits. And we've been working with them to do that IRS defense to prove that they do qualify for an ERC. A lot of it is like a general algorithmic disallowance that may have nothing to do with what whether or not it's a good claim or not. And so some of them are actually quite easy to defend. I would say if anybody out there is waiting for an ERC to be paid, we can probably help find out status and then see whether or not anything needs to be done in terms of IRS defense around that. So that's our group generally, and now let's go specifically. So I'm going to focus and turn it over to Vivian so she can talk quite a bit about how we're going to attack R&D for the clients of our firm for I would say the rest of the year and next year as we contemplate what's happening around both disclosure requirements changing and the law potentially changing. So Vivian, take it away. Sorry I talked too long as always.
All good. So I'm going to probably just do 10 minutes. So I'm going to blow through all of the slides and then we can leave some room for questions towards the end. So the most important thing now is we need to be talking and we need to be looking at your R&D process because there are a lot of changes and ultimately we're here to help, right? We're here to help get it right. And we're here to help you so that you can tax plan better. So 174 capitalization impacts your NOLs and your credit utilization. So getting those numbers right. So your goal would be to minimize 174 while maximizing your R&D credit. So although the new draft bill suggests that domestic R&D capitalization will be suspended for your 2025 tax year through 2029, you still need to capitalize for 2024. And for your foreign R&D spend, you would still need to capitalize and amortize that over 15 years for the foreseeable future. Also, the most important change that has been around R&D credit is the new Form 6765 documentation requirement. So the form itself changed drastically for the 2024 tax year. There's a new Section G that's optional for 2024 tax year, but starting in 2025, that would be required for most, I guess, taxpayers who are claiming the R&D credit. There are some, I guess, exceptions. So if you're claiming against payroll taxes, or if you have below a certain number of qualifying research expenses, you won't have to complete Section G, but for most taxpayers, you would have to complete Section G, so we can get into that as well. And then there are also, as Marty mentioned earlier, amended refund claims for R&D credits. There are significant disclosures that need to be attached with your corporate tax returns and your flow-throughs, your personal returns to the extent they're using those credits. There's a 45-day letter that basically the IRS said, hey, we looked at your refund claim and you don't have enough information. You have 45 days to perfect this refund claim, or else it's going to be completely disallowed. And either your statutes have now expired or you would have to refile your amended refund claim. So that's important for us to be looking at as well. The monetization of R&D credits against payroll taxes that has increased from $250,000 to $500,000. That's, big dollars that we're talking about that we should be looking at. In addition to federal credits, you want to maximize your state R&D credits. So a lot of these need to be filed on a timely filed state return. So for example, Georgia, if you want to utilize it to offset your Georgia payroll taxes for immediate monetization, that's something that needs to happen now. Virginia, Maryland, Pennsylvania, Florida, these are all application-based R&D credits. So you need to be looking at those and applying by the application deadline. So Virginia is awesome because it's refundable. Maryland's refundable for small businesses. So a lot of things to be looking at. And then lastly, there are different ways to calculate the credit. So you want to be looking at both ways and figuring out which way is more beneficial for you this year so that you can maximize your R&D credit. I'm going to blow through the next few slides. These are really the qualification criteria that's related to R&D credits. So to the extent that you're doing R&D, in order to qualify, you have to meet all 4 parts of these tests. There are additional qualification criteria for internal use software, but we're seeing less and less of that. But that we can explore if you have specific questions around whether or not your software development activity is internal use or not. Qualifying research expenses. This is what goes into your R&D credit. So W-2 box 1 wages, that's the most important part. I would say in the event of an audit, the first thing that they ask for is give me all of your W-2s. So instead of claiming this on gross wages or claiming the R&D credit on like, I guess, numbers that include payroll taxes, benefits, it needs to be solely on box 1 W-2 wages or guaranteed payments. For supplies.
That's the #1 issue the IRS will always look at almost any time. That's always #1 question. Did you use box 1 W-2? And you do that for the credit, but not necessarily for the 174. So
that's right. Yeah, for 174, you're looking at loaded employee costs. So that's your gross salary plus your benefits and your employee taxes and all of that. There are 2 separate buckets, or 3 actually separate buckets outside of wages that go towards the credit. So these are your supplies, prototype expenses, or your cloud hosting costs. So cloud, Azure, your AWS costs for standing up dev environments. Third-party vendor costs, these are probably the second largest tranche outside of wages that would go towards your credit. So to the extent you're paying folks in the US to support or perform R&D on your behalf, you could potentially claim their costs as part of your R&D credit. Going down to the 2 ways to calculate your credit, and this is why it's important to evaluate year by year, because these are elections that you can make. Generally speaking, for startup companies, it would be more beneficial to claim under the traditional method, because 1, you have low gross receipts, and 2, the rate is higher and your QREs are relatively flat. However, as you become a more mature company and your gross receipts are higher, or you have a year where you're significantly invested in R&D, so you have a big jump in your qualifying expenses, that particular year, that's probably a trigger for you to see and look if the alternative simplified credit method is more beneficial to you, because the ASC method rewards that big jump because it's comparing that to the prior 3-year R&D spend. Again, this is just a reminder to make sure that you're looking at it both ways and that you're maximizing your credit. We typically come in free of charge to scope your R&D benefit to see, 1, is it even applicable to you? 2, is the ROI there for you to claim your credit? And then we come in and we perform the R&D study. We would recommend, hey, based on your profile, your risk profile, or your amounts of credit, it might be more beneficial to do a full study so that we can prepare an IRS audit-ready deliverable that contains your contemporaneous documentation. We prepare the project write-up so that we can substantiate how your credits meet the 4-part test, or how your activities meet the 4-part test. So again, everything is tailored based on your facts and circumstances.
And it's most important, I think, going forward, it's no longer just a numbers game. Even if you're doing it, whether you're doing amended or sticking something on a currently filed return, much of that work, again, that would normally sit in the file waiting for the IRS to look at it, has to be done affirmatively for it to even be filed. And so you can't, there's just more work to do, but it doesn't have to be difficult, right? I think that's I look at this process slide and I'm thinking, look, we have new disclosure requirements coming up. We have capitalization maybe or maybe not disappearing for a temporary period, but only for domestic and not foreign. And then we also have this little nuance that we didn't talk about of whether you did or did not elect a reduced credit, and whether you have to, because of the capitalization regime, how that's done. I've just seen so many elections get missed one way or the other. And so I'm just encouraging everybody on this. It's almost impossible to say that R&D is business as usual, even if you don't have any tax liability right now to take it, to have it stick and have it be a relevant thing to carry forward as an attribute. Just reach out and have us take the time to do it.
Yeah, there's too many changes in the R&D world for us not to be contacted. So reach out to us, we're here to help. So new disclosure changes, right? So new form 6765. I think the most important thing would be they are just asking for more and more information, qualitative information than they did before. So specifically, this is their way of weeding out bogus claims. If we go down 2 more slides, you kind of see it in section E. They're trying to figure out, hey, are you claiming new categories of QRE that you previously didn't claim before? Because they want to make sure that you're doing the right thing, that you're accounting for consistency adjustments. Are there any acquisitions and dispositions? Because they want to make sure that you're correctly applying the consistency rules to your newly acquired firm or your newly disposed firms. Officer wages, they want to make sure that, hey, are these folks generating the majority of your wage QREs? And if so, you want to make sure that you're documenting the hell out of this because they are looking at it. And then section G, which on the next slide is basically asking all of this upfront information, locking the taxpayer down to what business components is generating your credit, what new information you're trying to discover. All of this needs to be on the new form 6765. So they're asking all of this upfront and locking taxpayers down to particular numbers so that in the event of an audit, you don't have time to be scrambling. You're doing this upfront now. So is it new software that you're developing, or is it a new formula, is it a new process, is it a new technique? These are probably things that you previously never thought of. Now you have to be thinking about that, and that's where we can help guide you to make sure that you're making the correct and appropriate selection. They're also going to ask you to break out your wage QREs by either someone who's directly performing, directly supervising, or directly supporting R&Ds. So these are all things that you previously didn't have to contemplate. Now you have to. So now you have to call us.
And none of this is meant to be scary. It's really just meant to say, hey, we have these internal resources within the firm. I mean, we kind of live for this stuff. So, and we make it pretty easy on you. So if you want anything done, or again, that complimentary assessment, we're around. So please reach out. Just don't reach out tomorrow morning because I'm having a baby, but otherwise we're good. So.
And I know I'm going a little bit over. I just want to cover one slide on section 174. So Marty, we can go to that table. R&D credits, you're looking at qualifying research expenses that fall within that 4 buckets that we talked about. This way, you're only, for 174, you're looking at all costs incidental to R&D. So it's depreciation on the hardware and equipment, laptops that you're using for R&D, software licenses that you utilized. So again, this is something that we noticed a lot. Software licenses that are used in R&D is not qualifying research expenses for the credit. Only the rental of cloud computing servers, that is R&D credit eligible. So software licensing like GitHub, for example, or your data subscriptions that you're using, to train your AI model, those are not credit eligible, but they are 174 depending on how they're being used. And then G&A, that's probably the second largest buckets outside of your fringe benefits. So rent, utilities, how you guys are, basically like overhead. Those are all relevant costs and that need to be allocated towards R&D. I only have 2 minutes left, so I want to open it up to questions, make sure, any questions around tax policy, IRA, R&D. Anybody? If not, I can go into more.
Just say this one last thing. With the fewer and fewer IRS resources out there, there's another uncertainty there as well. And I think that getting that form right on the 6765 and making it meticulously correct, they could come up with any reason to bounce the whole credit claim without that. And it's sort of like, instead of since they don't have the resources to audit this stuff, they're going to look for as many ways as possible to bounce your original claim. So that's the other thing. Casey, anything else right now, or that's it? All right.
Just stay tuned to all of this. Ultimately, tax policy wise, I think very much TCJA and 174 wise, something is going to happen or not happen in the coming months. It is going to impact taxpayers, whether there's action or inaction, whatever that looks like. There will be strategies to implement, again, to take advantage of advantageous provisions and to mitigate the impact of disadvantageous provisions. And so just stay tuned. There will be action to take. We just aren't exactly sure what action that is yet.
TCJA may not be here, but TCIA will always be around for you. So
Always.
with that said, I think that concludes the webinar today. I want to thank everybody for joining. And I want to thank Jeff as well for developing the relationship with everybody who joined today. Again, if you have any questions, reach out anytime. We do value your feedback. If you could take part in this short survey, that'd be great. Just remember, recordings will be available in about a week. So thanks.
And look for next month's topic on state and local tax. Not only do we spend a lot of time with all our clients on with Vivian and her R&D team right now, but we're spending a lot of time with our clients making these very complicated rules with state and local taxes that all our clients are filing in various states now. So that should be a really interesting discussion as well. So thanks everyone for attending. Bye-bye.
Take care. Bye.